Hello and welcome to the Forma Models monthly and annual business plan financial model. This model can be used to prepare and analyze a business plan forecast, regardless of industry, using a three-statement model complemented by key industry-agnostic metrics. The monthly Pro Forma tab includes all assumption inputs as well as the calculations for the income statement, balance sheet, and statement of cash flows. The annual Pro Forma tab consolidates the monthly Pro Forma into an annual summary report. The model is dynamic for up to a 5-year forecast period and allows for a variety of debt and equity assumptions, including the ability to buy back or issue debt equity throughout the business hold period. The Output tab provides print-ready formatted reports of key metrics and indicators, which can be used with investors and lenders as an investment and business plan supplement. This financial model is completely dynamic and industry agnostic, making it a useful financial planning and analysis tool regardless of business type. The README tab states the model purpose, highlights common use cases, and provides an overview of functionality, formatting, and all of the unique modules within the model. This tab also provides additional documentation, contact information, and a summary of additional products and services available from Pro Forma Models to support your analysis needs. Let's start this model walkthrough at the monthly Pro Forma tab. The monthly Pro Forma includes all assumption inputs as well as the calculations for the income statement, balance sheet, and statement of cash flows. Assumption inputs are grouped and hidden for usability, but let's start by unhiding them. Cell G7 contains a date input to start your analysis. Following this input, we start by modeling the starting monthly revenue and month-over-month revenue growth. The cost of goods sold as a percentage of revenue is entered next. As a reminder, cost of goods sold is deducted from revenue to calculate the gross margin. Payroll expenses can make up a substantial portion of operating expenses. Due to their large expense burden, corporations at times will employ dynamic staffing models with staff working seasonally or only hiring people once certain metrics, such as a sales or profit target, are met. The Pro Forma Models business plan has a complex and dynamic payroll module allowing for a variety of different staffing programs. The position name is entered in column B. The start date of employment is entered in column C. The number entered in the column relates to the model month number. For example, month 1 will be the first month of the model and month 12 will be the 12th month of the model. If you want a position's employment to begin in the first month of the forecast, enter 1 as the start month. The end date of employment for model purposes is entered in column D, similar to the start month. The end month relates to the model month number. For example, if you want to model an employee for the entire 5-year analysis period, enter the end month as 60. If you wanted to hire a position for a project in year 3, but won't need the position beyond year 3, you can enter the start month as 25 and the end month as 36. Payroll burden is for overhead related to payroll expenses, such as payroll taxes and benefits. The payroll burden figure is entered in cell F30. An annual payroll inflation assumption is entered in F31 to account for annual labor expense growth. Selling, general, and administrative expense assumptions are entered next. Preloaded model assumption line items include delivery, advertising, and administrative costs. Some of the expenses, such as delivery and advertising costs, are input as a percentage of revenue, while other expenses, such as insurance, are entered as a flat monthly dollar amount. This section also includes the corporate income tax rate assumption that will be applicable to your use case. The final operating assumption section is for real estate costs, which include rent, insurance, taxes, utilities, and maintenance costs. These values are entered as a flat monthly value to forecast the annual real estate and facility costs for your business operations. With these assumptions completed, the income statement will begin populating in a neatly organized and logical format. Cost of goods sold are deducted from revenue to calculate the gross profit and gross profit margin. Gross profit is followed by operating expenses. Total operating expenses are consolidated and then deducted from gross profit to generate the monthly earnings before interest, taxes, depreciation, and amortization. The monthly earnings before interest, taxes, depreciation, and amortization is complemented by a calculation of the monthly earnings before interest, taxes, depreciation, and amortization margin. The earnings before interest, taxes, depreciation, and amortization is followed by depreciation and amortization deductions. Depreciation is split out in the model to segregate depreciation for the business acquisition if you are acquiring through an asset purchase, real estate depreciation if you are buying a facility in the transaction, and general capital expense depreciation. Depreciation expenses are deducted to calculate the monthly earnings before interest and taxes. A calculation of the earnings before interest and taxes margin is also included within the income statement. Interest expense is segregated by interest on real estate debt if you are buying a facility and interest on the business acquisition. Interest expenses are deducted to calculate the earnings before taxes. Taxes are then deducted to determine the monthly net earnings and net margin. It is now time to input the balance sheet assumptions. The days of sales outstanding, used to calculate accounts receivables, and the days of payables outstanding, used to calculate accounts payable are entered next. These are key inputs that impact the balance sheet as well as working capital, which impacts the statement of cash flows. The next section of the model calculates and summarized the monthly depreciation expense for capital assets. The depreciable asset schedule handles inputs as the item label in column B, the date of acquisition in column C, the expense in column D, the number of months to depreciate the expense over in column E. The columns to the right calculate the monthly depreciation by item depending on the applicable months of depreciation you input for the specific item. At this stage in the modeling process, the balance sheet will begin to populate. Please note that Pro Forma Models never utilizes plugs within our financial models. This means that all items flow through each of the three statements through the use of supporting schedules rather than utilizing accounts to force balance the statements. This leads to enhanced accuracy and credibility. The balance sheet models assets split into current and non-current assets. Liabilities are also modeled as current and non-current liabilities and includes any applicable debt used as part of the transaction you are analyzing. The balance sheet concludes with the equity accounts. Following the accounting equation that assets need to be equal to liabilities plus shareholders' equity, a check is worked into the balance sheet to ensure the accounting equation holds true. The next section in the model contains the line of credit and long-term debt forecast. The line of credit is used to fund any operating cash shortfalls and includes an assumption for a minimum liquidity metric. To model the line of credit, we begin by entering the percentage of accounts receivable to be financed in cell F136 and the percentage of accounts payable to be financed in cell F137. If you desire to include a minimum liquidity threshold, the value can be entered in cell F142. The calculations will automatically determine how much will be drawn on the line of credit. The monthly amount will be displayed in row 144. The benchmark interest rate can be entered in row 146, and if your debt has a spread, it can be entered in row 147. The long-term debt section is used to forecast financing used for long-term assets, such as acquisitions and capital expenses. The monthly principal payment you will make can be entered in cell F154. If you desire to make additional monthly prepayments on the loan, the value you desire to prepay can be entered in row 157. The calculations in row 165 to 167 calculate the total monthly interest payable on both the line of credit and any applicable term debt. A cash flow statement is presented next, which begins with a calculation of the monthly changes in net working capital. The cash flow statement is organized in an industry-standard format with cash flows broken out by operating, investing, and financing activities. The cash flow statement concludes with a calculation of the monthly incremental cash flow as well as the monthly beginning and ending cash balance. This is incredibly useful for risk management, understanding run rate, and the ability to invest further in the business or pay down debt. The three-statement financial model is now complete. The monthly three-statement model concludes with a summary of key income statement and balance sheet metrics. Key income statement metrics include various measures of profit and profit margin as well as the interest coverage ratio. Balance sheet metrics include the days of sales outstanding, current ratio, quick ratio, and debt to equity ratio. The detailed monthly three-statement pro forma is complete, and we will now move to the annual pro forma tab to review the annual consolidation. The first section of the annual pro forma is the income statement, which is in the same format as the monthly pro forma and works from revenue down to net income on an annual basis. The balance sheet is then summarized on annual basis and includes a check to ensure the accounting equation holds true. The annual summary of the balance sheet is very useful for valuing less liquid items, such as equity. The cash flow statement is then summarized on an annual basis, replicating the same format as the monthly pro forma. The key metrics shown in the monthly pro forma tab are recalculated on an annual basis and provided at the bottom of the sheet to conclude the annual pro forma tab. The Output tab contains the high-level reporting output of the business plan and is preformatted to be printed or saved as a PDF. This output will make a great exhibit to a business plan and will be useful in sharing with investors, lenders, and other stakeholders. The report begins with a visual summary tracking revenue, cost of goods sold, and gross profit, as well as a separate chart tracking annual revenue growth. The following section of exhibits tracks annual expenses and expense growth with an additional chart tracking annual operating margins on a variety of bases. The report concludes with a matrix summarizing key income statement and balance sheet metrics on an annual basis. Thank you for tuning in. We hope you enjoyed this pro forma models walkthrough and encourage you to visit our website to try the model for yourself.